It's Tuesday, November 7th, 2023, episode 18. I'm Patrick Ceresna with our weekly Market Huddle Plus 30-minute catch-up interviews with past guests. This week, we have the pleasure welcoming back Aidan Garrib. We're going to discuss his macro views and his thesis on oil sector. So let's get Aidan on the call. Aidan, how are you doing today?
Hi, Patrick. I'm doing well. How are you?
I'm good. It's so great to have you back on the show. It's been way too long.
Yeah.
Looking forward to pick your brain on the markets. I know you want to share your oil thesis. We'll get to that in a moment. But there's been so much going on in the markets. I just want to get a high level view from you of where you stand on the markets and what's going on. I guess the first thing though that I want to kind of pick your brain on is, do you believe in your mind that the financial conditions are now legitimately tight and that central banks are pivoting into a pause here? Or do you think that there's potential for more rate hikes? What's your take on it all?
Yeah, good question. So I think there might be one more rate hike. I think that's essentially what's being priced in here. You have seen financial conditions start to tighten a little bit here. They've eased up in the last couple of days as there's expectations for this more dovish Fed, and you've seen longer end bond yields rally. So I think actually what's perhaps a little bit more important than just the rate hike outlook, it's the fact that throughout this hiking cycle, the Fed's balance sheet has been expanding, and particularly on the liability side, those metrics that drive liquidity into the market have largely been expanding as well. And so my view is don't focus so much on the rate hikes, whether they're done or there's another 25. I think really what you want to focus on is the fact that as we head into the new year, the balance sheet is going to start to get wound down in earnest, or at least liquidity is going to start to filter out of the system because of the combination of what the Fed's doing and Treasury issuance. And so that could overwhelm, 25 basis points in either direction.
So, do you think that impacts asset prices? Are you generally in the view that this is going to stress the markets?
Yeah, and so I think I think if you look at the academic literature, there is evidence that, central bank balance sheets do impact markets. Now, it's not just a linear function of, QE higher, stock prices, although sometimes it seems that way. There's a signaling impact that comes from quantitative easing that the central bank's going to be dovish for longer. So that tends to compress risk premia. And then the other factor is that when central bank balance sheets are expanding or bank reserves are increasing, the cost of banks' balance sheets decrease. So it allows them to facilitate more risk taking. That's the metric. Those are the metrics by which I think balance sheets matter for markets. And so as we head into the new year, where not only do you have quantitative tightening, but that reverse repo facility looks like it's going to be drawn down completely. At the same time, you have a lot more treasury issuance. I think it's going to lead to just tighter financing conditions, tighter financial conditions, and put upward pressure on the dollar here.
So that's a great segue because I wanted to ask you about the dollar. I mean, we've obviously gone through at least a couple weeks of the dollar pausing, but when I pull up the chart here on the dollar, it's been a pretty strong run since the summer, and it really feels like we've broken out of a dead zone trade range that was in place for most of the year. Do you see this still as a potential buy on dip opportunity on the dollar that continues higher? And if it does go higher, are we going all the way back to 2022 levels?
So I do think that the dollar is going to head higher. The stabilization that you talked about has largely been due to the euro kind of bouncing off its short-term lows around 104, 105. Now we're up 106.8 roughly. Whereas the yen, we had blown through 150, we came back a little bit to 149, and as I speak to you today, we're back above 150. So the kind of stabilization that you've seen in the dollar really has been the euro, more a story about the euro. The euro right now, what's been driving that is just the front end spreads between the spreads between German and U.S. Treasury yields. So 2-year German Bund yields minus US 2-year U.S. Treasury yields right now are the factor that's driving the euro dollar exchange rate. And so I think, what the market's pricing in here is for, a cutting cycle from the Fed to begin in earnest. My view is that, the ECB faces more pressure to cut, whereas in the US, the Fed, while they may hike 25 basis points or maybe pause here, I think it's, they're going to try to keep rates here for longer because of the underlying, pockets of strength that you're still seeing, for example, in the labor market and in wages. And so, it's not, you're not seeing inflation really reaccelerate higher, but you're really just seeing this inflation remain kind of sticky here, particularly in the labor market. And I think that keeps the Fed tighter than what you get from the ECB. And so I think as that starts to get priced in here, and as you get less dollar liquidity coming in the first few months of 2024, the dollar strengthens. Now, do we go back to the 2022 highs? No, I don't think, like the rate differentials would support that. I think, as a base case, I think a tail risk to that is that if you do get inflation start to reaccelerate a little bit here, because of something in the Middle East or oil prices, then there's more pressure on the Fed to tighten, lest they fall behind the curve. And then I think you could see the dollar rip higher. But right now I think a lot of it just has another tail risk, I guess, for a stronger dollar would be if things ratchet up in Russia, Ukraine, which has come out of the headlines, but there's still activity there.
So, talking about inflation, obviously there's a very large amount of people that have now really started to position themselves that secular inflation is here and that inflation is going to stay sticky and here going to be for a while and it's going to impact bonds. Are you generally in that camp on inflation, or do you think we're going to have some sort of disinflationary cycle where everything kind of mean reverts back toward the typical zones we've seen in the past?
Yeah, that's the kind of the $64 trillion question, I guess. Um, so if you look at inflation expectations, so break-even inflation, which is just the difference between nominal yields and tips, that's still pretty well anchored at about 2.4%. But if you look at more, and I think that market's basically distorted by the Fed because they have, about 25% or 20% of tips on their balance sheet that they're letting mature. But if you look at inflation swaps, so what the private sector is using to kind of hedge their inflation expectations, that's basically at almost 2.8%. And so I think over the short term, inflation is going to remain a bit sticky here, particularly if you see an uptick in energy prices. Food inflation has been quite strong. Shelter inflation's coming down slowly. So I think just over the short term, inflation is going to remain above the Fed's target, call it 3.5 to 4%, and kind of keep U.S. monetary policy tight. Over the longer term, there's two big, I guess, crosswinds, right, when it comes to inflation. One is the fact that you have these demographic changes, which I kind of hate talking about demographics because it just seems like this kind of fluffy long-term issue that never, really gets here. But millennials are now the largest cohort of the population. They're aged between 28 and 42, or 30 and 42. So prime child rearing age. As you see older, more experienced workers leave the labor market, firms are being forced to hire more millennials into senior positions. So you're essentially replacing older, more experienced workers with younger, less experienced workers. So that has an impact on productivity, which is going to be, like weaker productivity. So firms may have to increase prices there. And then also, as you get millennials become the largest cohort of the population and they're in peak child rearing age, well, they start to buy houses and cars and, baby seats and, and all that kind of stuff. So I think that you have this kind of catalyst here for, for inflation to the upside. And then kind of counteracting that over, I guess, the longer term is really the fact that you have this AI revolution, which I think is real, and that's going to drive down the cost of many services and goods as well. So I think you just have these crosswinds here. And so I think one of the takeaways of that is, people always ask, what's my outlook on, would I be buying 10-year treasuries here, for example? And, I don't want to ramble on too much about this, but my conclusion is, look, it depends on what your mandate is. If you are a pension plan um, that's perfectly funded or overfunded, and you have a hurdle rate of 3% or 3.5%, which is what a lot of the studies show, then for sure, buy 10-year treasuries at 460 and then, go to the beach and drink some beer. But if you're worried about 50 basis points moves in either way on treasuries and you need to position for, real returns, then I would be perhaps less optimistic here on treasuries, and I would be looking for other pockets of the market where you could kind of, get value with a big V, so growth versus value, and sort of a bit of an inflation hedge. And then that's why I want to talk to you about energy
Oh, for
today.
sure.
So sorry to
No,
ramble there,
listen.
Patrick. I've had too much morning coffee here.
Listen, no worries, buddy. Before though, we get to the oil thesis, 'cause I want to get there right now. I would
Sure.
really, you're a fellow Canadian, and obviously boots on the ground in Canada. And one of Kevin's big themes or theses is that he thinks places like Europe and Canada will fall into a recession much quicker than the U.S., and that you'll see the cracks there. Obviously, Canada's a big issue with the mortgage market because of the short duration and interest rate resets that happen in Canada. That Americans with fixed rates don't have the same risks. What's your take on the Canadian economy, and do you think we're in a recession in Canada? What's your take on that?
Yeah, I think, we're going to we're getting the economic data, which isn't necessarily looking good. I do see the strain here on the ground where, as it pertains to the real estate markets, you do see a lot more houses for sale, and they're, on sale for longer. The mood here has become a lot more, I would say, dour. One thing that's helped bolster the economy from a headline perspective is the fact that we have had so much immigration here. That's been big news in Canada. I think over 1 million people last year, which is a sizable percentage of the population, and so that's helping growth, but it's also fueling a lot of the inequality and the price pressures that you're seeing, particularly when it comes to rent and to housing and to other uh, kind of necessary goods and services. So my view is Canada probably does head into a recession, particularly as the Bank of Canada needs to remain tight, given where dollar CAD is here. What kind of reinforces that view is you're seeing U.S. goods demand slow, and so that's going to take its toll on Canadian exports. And so while Canadian energy and oil might be a bright spot, I don't think that's going to necessarily be enough to bolster the overall economy. And so that's why I think there's some opportunities in the banks where you can perhaps go underweight the bank equities, and actually there are these non-viability contingent capital bonds and VCCs that the banks issue. They're basically like the COCO bonds that we've seen in Europe, but they are far more stringent in terms of what it would take for those bonds to be converted to equity. So you'd need uh, OSFI, the bank regulator, to essentially publicly disclose in writing that Bank X is a non-viable entity. And as someone sitting here in Canada, for that to happen to one of the
Tier one banks.
the big
Yeah.
banks, such a huge tail risk, right? There would be broader problems if that was occurring. And so, these bonds, they offer 10%. The rates reset every 5 years at whatever the 5-year Government of Canada bond yield is, plus about 200 to 300 basis points. So you're still getting some kind of like inflation protection, or so if inflation picks up, bond yields kind of pick up, you are getting a little bit of a premium to that. And so that yields about 10%. And if you use that as a pair trade to be, short some of the bank equity, then that's a positive carry pretty good tail risk trade that I like there.
All right. Well, one last question then, because I mean, on that topic,
Sure.
okay, so I have here the chart on the Canadian banks. This is the financial institution ETF. Obviously, they've been very weak, but is there still, in your mind, further risks to these banks of them repricing still lower?
I think there is, and I think the big catalyst coming up is what you're seeing now, particularly with mortgages, is extend and pretend, right? So the banks don't really want to foreclose, so what they're doing is they're uh, rather than increasing the mortgage payments to reflect the higher interest rates that you're seeing on the variable rate mortgages, they are essentially just pushing out the amortizations for longer. And so this has two impacts. The short-term impact, which isn't great for the bank stocks, is that it should decrease cash earnings because they're literally getting paid less since the payments aren't increasing with rates. However, longer term, you could argue it's pretty bullish for the banks because what they're doing is essentially turning Canadians into indentured servants, right? If you push out the mortgage amortization from 30, 60, in some cases now you're seeing it like 80, 90 years, well, Canadians are just in debt for longer. So the return that the banks reap on that loan is going to be substantially higher, right? So I think over the short term, there is that kind of weaker outlook as cash earnings struggle, but then longer term, I think it's a pretty good place that the Canadian banks are setting themselves up to be in.
Perfect. Well, yeah, I agree with you completely, and it's going to be really interesting to see how this continues to play out here. I'll definitely get you back for an update if things start to well, let's say shit hits the fan or something. Anyway, let's move on because you have a great oil thesis. I want to hear all about it. What's the opportunity you see? I have the chart deck here. Take us through it.
Sure. So, as someone I listen to your many podcasts or your few podcasts avidly, and so if as you've mentioned many times, the Mag Seven and the wider cohort of the mega cap tech complex, they've really led the equity market rally, not just this year, but with rare exceptions since 2015. And so the institutional investors that I speak with, they still want to keep that exposure, but they're also looking for pockets of value to diversify their portfolios. And so the one idea I had is the oil servicers, because not only do they provide that diversification benefit and they're kind of commodity related as well, but I think there's also a structural bull market in the industry. And you're seeing, although in the US we talk about weak capex from a real perspective and capex kind of flatlining and rolling over, as you're showing in this chart, I show overall the trailing and forward capex in the energy space versus the one of the oil servicers ETFs here. It's OIH, it's the Van Eck one. Now there's a few of them. There's also obviously about 24 stocks that kind of are in here. So I would just encourage investors to do their own due diligence and their own work because I don't really provide buy or sell recommendations. But I think as an industry or a sector, this looks attractive, and you're seeing the share price of the ETF here increase in line with capex in the space, and I think that this is going to be a secular trend here.
Well, that's music to my ears, Aiden. No, but anyway, so on page three here, you have the leading indicators on the U.S. oil output. What are you showing here?
Yeah, so why I like this chart is because at first blush, when you look at this chart, the outlook doesn't necessarily look great for the oil servicers. So what this chart shows you are well completions in the US versus the frac fleet count and shale production. So, well completions, just how many oil wells are being completed in the US. That's kind of flat line to edge lower in the last few months. The frac fleet count, kind of a tongue twister, but what that is that's the set amount of pieces that you need to start pumping and extracting shale oil, like the water pumps, the sand trucks, like the all the equipment that you need. And so that tends to be a pretty decent leading indicator of shale production. But really what you've seen is that neither well completions nor the frac fleet count have increased. They've basically flatlined as these shale companies find fiscal Jesus, for lack of a better term, and start to return more money to shareholders instead of just pumping it into the ground. And so shale production has come back, but I think the growth that you're likely to see going forward from shale isn't going to be that great anymore. And so then you might ask, well, okay, if shale production isn't going to necessarily grow, if you're not going to see activity in the shale patch, then why are you seeing capex in the energy sector, and why are you so bullish on the oil servicers? And that's the story that I start to build over the next couple of slides here.
All right, so let's move on to page 4 here. American oil after the shale revolution. So what are you showing here?
So what I'm showing in this chart is U.S. shale oil production, which has grown, and we're just about roughly below 10 million barrels per day, and then total oil production in the U.S., which has hit about 13 million barrels per day. And you're seeing this spread start to widen where shale production looks like it's flatlining or just maybe growing at kind of a 45-degree line there angle, whereas total oil production is picking up. So the message from this chart is that the US is producing more oil, but actually it's not coming from traditional shale plays, it's coming from somewhere else. And that somewhere else is where I think the investment case starts to build for the oil servicers.
What are you showing here, though, on the heading south and thing? Is it all about Mexico now?
Well, it's actually the Gulf of Mexico, and so a lot of the yeah, I've maybe held the listeners too long here and buried the lead, but a lot of the capex that you're seeing right now is happening in the Gulf of Mexico, as well as just basically deep water plays or offshore plays, both in the Gulf of Mexico. But then also, I think what's catalyzed this too is Guyana, which their reserves are more or less their offshore reserves are more in line with Saudi reserves, not as cheap to extract, but those are kind of the estimates, and that's supposed to be the next big thing. And so as long as oil prices are above 75, $80 a barrel, it gives the firms, the E&P firms, confidence that this is going to be kind of economical for them to exploit. So here, what you're seeing is Gulf of Mexico oil production and then Gulf of oil nat gas production. So Gulf oil production has increased. I think you're going to see this both from a secular and cyclical perspective. So I mentioned Guyana, but there's also some U.S. energy policies that are going to lead to more capex in this space. And then also the nat gas production in the US. So we've seen the quote unquote mysterious explosion of the Nord Stream pipelines. And as that's occurred, Europe has become more reliant on US nat gas than it has on kind of other places. And so that's kind of bullish. As I mentioned, U.S. energy policy, and you kind of just beat me right to the punch here. So on this chart, what I show is the U.S. Strategic Petroleum Reserve, not just the quantity, but I break it down by crude type, which often isn't done. And so a lot of people will just say, look, the SPR has declined, which it has. But what's more important than just the headline decline that you're seeing has been the fact that it's been heavy sour crude that's been drawn down faster. That's not the crude that America produces. America generally produces light sweet crude, but the refiners in the US prefer they
Blend.
need heavier blending stock, as some of your other guests have talked about in the past. And so traditionally that heavy blending stock comes from Canada or Venezuela or Saudi. Saudi's cutting that production of heavy crude. Canada, it's still trying to pump it and sell to the U.S. The problem is we can't really build, pipelines on either side of the 49th parallel, so that hinders how much volume you can pass through. You can ship heavy Canadian crude by rail, but that's more costly, and it's also, kind of a treacherous or dangerous endeavor.
Yeah.
So to the extent that the U.S. needs to rebuild the SPR, they need to refine more crude, and that's going to require heavier crude, and that's really the epicenter of where I think the bull case is for the oil services, which you'll see on the next slide.
Well, before we move on, though, because you did
Sure.
mention obviously that Canada is one of the countries that can produce the heavy oil, but Venezuela obviously has a huge political risk. But do you think that this situation in Venezuela inevitably leads to them, accepting the fact that they're the political structure there and starting to really open up the sanctions and start moving Venezuelan oil? Do you have a geopolitical view on that?
Sure, yeah. So I'm not a keen believer that you're going to see the policy shift from the Venezuelan government to basically have free and fair elections in the next couple of years. In fact, they cracked down on an opposition candidate just this month or last month. Moreover, Venezuela's had a dearth of investment in their energy patch because it's been so mismanaged. So I don't think it's going to be easy for them to pump crude. And to the extent that they do get more crude, well, that crude has typically gone to pay back Russian and Chinese loans. So best case, let's just say they open up, investment, I guess, floods in, and there's an immediate increase in crude output. I think the first batch of that would need to go to repay some of these loans.
Yes.
So it really is incumbent then on the U.S. to find the heavier mixing or blending stock elsewhere. And I think this chart that you're showing right now is really the epicenter of the bull case for the servicers. So WTI tends to be very light and very sweet, and I've mentioned repeatedly here that you need heavy blending stock. So what this chart shows, or this map shows, are the crude grades in North America, and so you can see that Canadian crude, like in Alberta, there is that heavier crude that you can use as blending stock. But again, there's a dearth of pipeline capacity. We have problems building the pipelines. It's expensive and dangerous to ship it by rail. If you look at the Gulf Coast there, so there's Bonito, there's Mars, there's Poseidon, there's those oil fields and crude blends, and what you're seeing is that those are both heavy and sour, tend to be heavier and sour. They're also tantalizingly close, both to the Gulf Coast refiners and the pipelines there. So I think you're going to see a lot of capex in the space to extract this crude, and so the oil servicers, they're the ones that do the studies and go in and build the rigs and try to extract the crude. And so they're the ones that are really going to benefit from this.
Right. And so here on page 8, you've got the different oil servicers listed here. What are we looking at?
Yeah, so again, there's no buy or sell recommendations here. All I've really done is I've taken the components of the oil servicers ETF OIH, and I've just broken them out. On the x-axis you have price to free cash flow, and on the y-axis you have the free cash flow yield from operations. So I think given the spread, or the kind of the disparate nature of valuations and free cash flows, I think it provides investors an opportunity to do their own bottom-up work here and look at which one of these look attractive. Because when you look at it from this perspective, some look more expensive than others, some spit off more free cash flow than others. So you're able to find where there might be some relative mispricing or opportunities here.
Right, right. Well, listen, we're running low on time here, Aidan, but that's a great thesis and in line with my thinking on that. So thanks for being an echo chamber to me. No, but with that said, listen, let us know a little bit about you and where people can follow you and find you if they want to ask any further questions.
Sure. So I am head of global macro strategy at PGM Global. We're an institutional brokerage offering, best execution, agency only, global equity, ETF, and some fixed income to institutional investors. And one of the pillars of our business in line with that is the global macro research product that I run, where we put together daily actionable, concise research for institutional investors. So if you are an institutional investor, feel free to get in touch. My email here is on the cover. I also try to tweet a little bit at Aidan Garrib on X or Twitter. Listeners can reach out to me in either of these platforms.
All right. Well, Aidan, thank you so much for coming back on the show, and I look forward to having you back in the future. Thanks, buddy.
Yeah, it was my pleasure. Thanks for having me.
Thank you for tuning into the Market Huddle Plus. Next week, we'll return with our full show. See you later, everyone. Cheers.